Yo, Gem fan, welcome back to the channel. Dropping Gems FX. You already know my main goal is to lace you guys up with advice and tips to take your Forex journey to the next level. Bang, bang.
Bang, bang. Then he grabbed his dick, disappeared into the dark.
And to bring you guys along my Forex journey, right? In this video, I'm going to be talking about risk management. I'm going to go into depth on exactly what it is and what are the key factors I believe that go into understanding risk management. If you are a beginner trader or you're a trader that's been trading for a while but you lack consistency, this is the video that you want to have in your playlist, that you want to replay. Really digest this video because this video will make you a consistent trader.
Nice.
Without further ado, I hope you like the content. Remember to subscribe and like and comment. Half of you guys are not subscribed, so stop playing with me and subscribe, please. Subscribe, because I'm dropping nothing but gems, so subscribe so you can be notified whenever I drop a video, right? Without further ado, let's get right into the charts. Alright guys, so right now I'm on TradingView and I'm going to continue to use this platform to illustrate and kind of hit home on the topics that I'm going to be covering in my training series. So right now we are on GBP USD, right? And if we move up here, this is where I have everything set up. We're going to be talking about, obviously, risk management. And the definition, in my opinion, of risk management is to actively monitor, minimize, and control the probability of loss in every single trade, in every single day that you place a trade, and every month and every year. Minimize and control the probability of loss, right? And so there's three aspects that go into this when we talk about minimizing loss, right? You have to understand your account balance, right? How much money is in your account? It's very simple. How much money did you put into your account? Did you deposit $100? Did you deposit $1,000, $10,000? How much money do you have to trade? You need to understand that, right? And then based off that, right, if you have a $100 account, understand what pairs are more volatile, right? If you have a $100 account, you really have little capital to kind of let the markets play and do what it needs to do. So you need to understand, maybe you need to stay away from those pairs and trade pairs that are a little bit slow moving, especially if you're a beginner and you're trying to, kind of build that account up to 1,000 or 10,000, right? Understand your account balance and understand what pairs you need to be trading for your account balance, right? If your account balance is $100, stay away from gold unless you're not a beginner, right? If you're somebody like me, I'm very comfortable, like I said, depositing $100 and just trading gold for the whole week, right? And making and flipping, my account to whatever size, right? The next part of risk management, that aspect, is lot size, right? I did not cover what lot size essentially means in trading so far in this series, but I am going to in the future, because right now I've been, giving you information to build you, basically to build your understanding of what Forex is. But when we get into what lot size is for sure, that's when we're actually going to be trading, like actually placing trades, right? So we're not at that level yet, so that's why I have not brung it up. But in this video, you will get a little taste of what a lot size is. And essentially, a lot size is just the money that you will receive per pip. So in the last video, we talked about pips, right? We talked about the pips being the measurement and movement of price at a given time, right? So every time you are up a pip, you gain a pip, you lose a pip, money is coming in and out your account, and the lot size is directly correlated to that. So we're going to get to that in a minute. And the third aspect of risk management is to have a set acceptable level of risk, right? So what are you willing to risk per trade? Personally, I usually stick to around 20 to 30 pips per trade. If I'm in a trade, I set a 20-30 pip stop loss. If it goes the other way, I lost the trade, I must have seen or not seen something that I was supposed to. I must have done something wrong, or maybe it was just the wrong time to enter. I'm not going to be in a trade and be down 100 pips. I'm not going to be in a trade and be down 50 pips and continue to hold that trade, right? That's for me personally an unacceptable level of risk, right? I don't want to blow my account. So why would I continue to hold that trade? It's obviously not going in my direction. I'm going to get out that trade, cut my losses, and that is that, right? So risk management, and I feel like I should just have this disclaimer. If you guys don't really know what a stop loss is, right? So everything under this umbrella is directly correlated to your stop loss. So when you're thinking risk management, you're thinking you want to minimize and control the probability of loss, right? You understand you have $100 account. You understand what lot sizes you need to use per trade. You understand your acceptable risk level per trade. Then you know exactly where your stop loss should be in every trade, right? And if you follow that concept and that discipline, and you really stick to it, you will be a profitable trader. You will be a profitable trader. Or at the very little, you will minimize your risk. And that's all that we have to do in this market, because this market is not something that is for certain. If I believe that price is going to buy, like, the market doesn't care what I believe. The market doesn't care what you believe. The market is going to do what it wants to do. So, with that being said, let me take you over to an example so you can see how all three of these different, key concepts come into play under the risk management umbrella. Okay? So if we move over to the side, right? This is kind of geared more towards those who have a smaller account, right? If you have a smaller account, if you have $100 account, right? I typically, tell people, for every $100 account, your lot size should be 0.01, right? So if you have a $100 account, your lot size should be 0.01. If you have a $200 account, it should be 0.02, so on and so forth. But if you've been trading for a while, or even if you feel like your specific trading preferences, your style suits you to go up to a higher lot size with the $100 account, I definitely encourage you to stay within a 0.01, so a 0.05. And my personal acceptable risk level is 5% per trade, so I use that as an example here as well. So, in example 1, I just noticed that I don't have this labeled correctly because I'm a dodo head, but let's continue. Alright, so example 1, and this is an example of horrible risk management. And by the way, this little tool on the side is a very helpful tool that TradingView provides for short and long positions. The black line is your entry point. The red box would be your stop loss, and obviously the bottom of the red box would be the end of your stop loss. The top and the green box represents your take profit and your profit level. And they give you, your risk to reward ratio that we will be going over in the next video. Risk to reward ratio, the amount of pips, all these stats that are very easy to get with this tool, right? So back to the example number 1, horrible risk management. If you have a $100 account and you are in a trade with a cent lot size and you are down 50 pips, we're going to talk about drawdown, right? We're not going to talk about profits simply because I feel like I want to get you guys in the mindset of psychologically being prepared for losses, right? We need to be prepared to take losses and understand how to deal with that and manage that, right? So 1 cent lot size down, 50 pips, that means you're down $5, right? You're down $5 on a 50 pip drawdown. That means that you have 20 chances to win, right? If you have a cent lot size and you continue to place your stop loss at 50 pips, you have 20 chances to get a correct trade. Whatever the profit margin is for that, you just have 20 chances to be right. right? After 20 chances, you've blown your account. You have wasted $100, okay? On a 2-cent lot size, down 50 pips, you are down $10. Now your chances of being right dwindle down to 10. You have 10 chances to be right, right? A 3-cent lot size, down 50 pips, down $15. You have a little over 6 chances to be right, right? 6 point something. Again, 0.04, you're down 50 pips, you're down $20, right? Off of a $100 account, you're down $20, okay? That's a huge percentage of loss, right? You have 5 chances to win. 5 trades, 5 chances to win. If you do not win on any of those, you have blown your account. 5-cent lot size, you're down 50 pips, you've lost $25. You only have 4 chances to lose, basically, or win, actually. 4 chances to win. This is an example of horrible risk management. Number one, your lot size or your stop loss is way too big with 50 pips, right? We want to stay between 20 and 30 pips max. At 50 pips, like that's a large movement. That's a large amount of movement. Your bias, your analysis is completely wrong. Like just ditch it, right? Start again. Let the market do its thing and understand why you lost that trade, really. Yeah, so stay between 20 and 30 pips, right? We're going to continue on to a more acceptable example of risk management, right? So when we stick to 20 to 30 pips, for this example, I'm just saying 20 pips, we're going to understand how our chances kind of double from the last example, or triple, right? So on a $100 account with a cent lot size, you're down 20 pips, you're only down $2. You have 50 chances to be right. I'm pretty sure somebody who doesn't know anything about Forex could at least be lucky enough to get a couple wins, right? Off 50 chances. You have 50 chances to be right. On the a 2-cent lot size, you're down 20 pips, you're down $4. Obviously, may not seem like that big of a loss, but $4 is 4% of your account. So when you think about Forex and you think about growing your account, you think about having a $50,000 account, $100,000 account, which is what I do, right? I think about this a lot. The behavior that you kind of adopt at the lower level when you have a $100 account, when you're growing your account, is the same behavior that you're going to be in when you have that $100,000 account, right? So with a $100,000 account, a 4% is 4 G's that you're losing off one trade. Why do you think that that's acceptable? With the $100 account, it's only $4. So psychologically, you're like, oh, $4, like that's a 4 for 4. That's a, whatever, cheesesteak, whatever. I can do that. $4 is nothing. But when you think of a $100,000 account, that's $4,000 gone in a minute. Like, please, when you trade with a $100 account or a $1,000 account, stick to your discipline, because once you grow that account, it would be that much easier to continue to get money and continue to grow that account when you have a large amount of money, okay? So back to the example. All right, 0.3 lot size, you're down 20 pips. It's only $6. You have a little over 16 chances to win. 0.04, you're down 20 pips, $8. 12 chances to win. 0.05, down 20 pips, $10. 10 chances to win, okay? So, acceptable risk management, and this is my personal level of risk management, 20 to 30 pips, depending on how much money I had in my account. That would depend on the lot size I would use. Once you get to the point where you up your lot size, you get too confident, you forget about risk management, right? You get cocky. You forget about understanding how much you have in your account, the lot size that you're supposed to use, the acceptable level of risk, and say you up that lot size from a 10-cent lot size to maybe, let's say, a standard, one standard, which is 1.00. With the 20 pip loss, that's $200, right? With a $1,000 account, you just lost $200. You're at $800, right? So psychologically speaking, and maybe hypothetically speaking, your analysis was right, your bias was right. It was just, the market kind of fluctuates before it goes in the direction it wants to go. It's not going to automatically bounce back when you want it to, right? It's going to fluctuate. There might be some consolidation. You see your money going up and down and up and down and up and down. Psychologically speaking, you're going to be stressed. You're going to be thinking that you're wrong. You're going to want to get out the trade. You want to cut your losses too early because you're not comfortable enough with seeing that money come in and out, because you haven't gradually upped your lot size, because you didn't stick to the proper risk management, right? The only reason, and I feel like I can connect with you guys right now. Let me be real. Have you guys ever been in a trade and you're glued to your phone? You're stressing. You might as well be sweating. Your heart is pounding. Why do you think that is? I'll tell you why. Because you did not use the proper risk management. You're sweating because you over leverage. You're sweating because in a couple of pips of drawdown, you're going to blow your account. And you don't want that to happen. But there's nothing you can do. You can't control the markets. You fucked up. Right? Happened to me 1,000 times. 1,000 times. And this is why I can say this. And this is why I know. If you're a trader, you're a Forex trader, and you've done this, I know I can relate to you. I know you can relate to me. Right? So how many times is it going to take for you to blow that account, for you to do the same behavior, for you to change? Also, so I gave you two examples. One of horrible risk management, one of acceptable risk management. Let me go to the charts, right? I'm going to find an area of consolidation, basically a pattern that I like to use a lot, that I like to trade a lot. We're going to look for the retest, and we're going to look for the proper entry and understand exactly how much we should be risking and how much we should put on that trade, right? All right, guys, so we have the area of consolidation kind of mapped out, and we want to go ahead and look for our entry, right? We can see that the market broke out to the upside. We have that clear breakout of the zone, right? And what we want to do, we don't want to chase the market. We don't want to get in here. We want to wait, right? Area of consolidation. We'll wait for the breakout and the retest of the zone. We want to get in there and continue that bullish or that long position, right? So that's what we want to do, okay? So what you're going to do is come here on TradingView. You're going to look for the long position tool on the left-hand side, right? Your entry is at the top of the consolidation zone, right? Right? Your stop loss is going to be, if depending on your account size and depending if you're monitoring it or if you just have a buy limit, your stop loss is going to be at least half of the box, right? So how long is this? It's about 23 pips, 23, 24 pips, okay? Not bad. And then, depending on your analysis, you know, you're going to take it to the next high or whatever the case may be. That's going to be your take profit, right? We're not going to talk about risk to reward ratio right now. That's going to be the next video. That's a whole nother topic. But whatever your take profit is, you're going to have it set, and that's it, right? So your entry is here at 1.25196. Your stop loss is 24 pips below. If I had $1,000 account, I would put a 10-cent lot size on here on the trade. And my stop loss, if the trade went the other way, I would lose $24 roughly. $24. And we're not really worried about take profit right now, but let's say it's 100 pips. We would make $100. What the hell just happened? Okay. We would make $100. Okay? So that's it. Simple as that, right? Let's see what happens. Breakout. Retest. We're in the market right now. We're in the market right now. We caught a doji. Wicked out. We were in drawdown for 11 pips, 11 to 12 pips. That's $11 to $12. We're not really worried. We're not worried, right? Have confidence in your trading plan, in your analysis, and you will be fine, right? Boom. Let's continue. So we're in the trade. Right now we're up. What's profit right now? We're up about $24, right? 24 pips we're up. At this point in time, once market creates structure, okay? Created structure right here. And we have that rejection, that retest and rejection of the structure. Your stop loss, either break even, so it's a risk-free trade, break even, or put it in profit so you secure some profit, right? You take some money off the table. You do not allow the market to take it back, right? Take some money off the table, $24 off the table. Right now, you're up how much? You're up $140, 140 pips. Take money off the table. You took 24 off the table, whatever the case may be. And that's it. Never comes back down to hit your stop. Oh, actually it does because it's a W formation. But that's just a analysis for the bigger time frame. But yeah, you could have taken profit up here once you've seen the double and triple top. That's a clear reversal pattern. We have that same thing happening as we speak right now up top. Right? As you can see, before I even explain this, it was heading down. It's heading down even more. But I'm not going to chase the market. I'm not going to get into the market right now. My plan right now, I'm dropping so much heat for y'all. I love to trade GU, so I probably will get into this trade. So that's the area of consolidation right now. So if I get a breakout, which might be happening right now, who knows? But I'm not going to get in the market right now. It's way too early. It's only 2 o'clock. I'm going to wait till tonight. Breakout, retest, take it down to this level. That's it. All right, guys. So recap. To hit home, risk management, right? What we want to do is to actively monitor, minimize, and control the probability of loss. 3 key factors that go into that is understanding your account balance, how much you have, what pairs are more volatile, what pairs do I have to stay away from. Understanding your lot size that directly correlates to your account balance, right? And setting an acceptable level of risk. I can't set it for you. I gave you my example. You can use your own. You can use mine. I really don't care. But that's just what it is. You have to kind of gauge that for yourself. What is acceptable for yourself, right? And that is how you determine your stop loss. Okay? So, if you like this video, if you like the content in this video, leave a like, subscribe, comment, share this video with your fellow trader. Tell them to join the fam because I'm just dropping gems. I'm going ham. I'm dropping gems left and right for free 99. You feel me? The next video is going to be going over risk to reward ratio and understanding that topic. Taking that, combining that with risk management will make you a consistent trader for life. For life. For life. For life. You feel me? So, do what I just told you to do. 50% of you guys are not subscribed, man. Like, I don't understand. I don't understand. I look at the data. I look at the analytics. Subscribe. Watch these 2 videos over here. But subscribe. Stop playing with me. I'm going to catch you next time.